Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we are on the active and passive debate. Remember, if you pay attention, I didn't use active versus passive because it's no longer about one over the other. It's about the right blend in our portfolios. So our guests are with us. Now, the next question that we've been getting is how to invest in themes. And themes are very, very big. You gentlemen know, right? So infrastructure, PSU, defense, and typically investor psyches, when we see these stock prices surging, one gets a bit of FOMO. Right. And one wonders whether you should invest in the long term in these themes. So, Pradeep, first of all, what do you say to the feeling of FOMO? And then if one should invest, then what's the right route?
See, FOMO is something that is from the behavioral side of investing. Interestingly, it is coming up when we are discussing a passive, which is more quantitative and number-based. Yeah. But having said that, right, so whenever people think about thematics, the only thing that I keep saying is please look at how broad is the theme, right? So one mistake that investors can easily make is drive themselves into very narrow themes, which are very cyclical in nature. And when the cycle turns, market returns can be bad for a long period of time. So that is something that some people have to be aware of when you look at thematic investing, whether active or passive. So that is something that people should be aware of at all times.
Okay. And so now if we're getting products, and we are, right? We are getting products. There could be a defense passive fund, which is basically hugging the underlying index, or an infrastructure fund. Are the risks greater if you are going into a passive thematic fund versus one that's managed by an active fund manager? Yeah,
risk is also very well measured. In fact, SEBI has got a wonderful way of showing it in terms of riskometer, etc. You will notice that typically thematic funds are considered higher risk in terms of their risk profile compared to diversified funds, and there's no escaping that, right? The reason why somebody would want to play a theme is if that theme is their high conviction sort of a theme which will outperform a broader diversified fund or market over a period of time. So that's the whole idea of getting into a theme. And having said that, it should also be part of like going back to Harsh's point on core versus satellite. You should think about how much % of my portfolio can be in these kind of thematics, and that percentage cannot be very high. That much is clear.
Fair, fair. So actually, on that, Harsh, let me come over to you. You said core and satellite. So in satellite, some thematic funds perhaps that still merit a place. Which are the themes? What kind of funds would you allocate money to right now?
So, I'll just talk about certain smart beta funds that an investor could possibly consider. It need not necessarily mean that they're thematic in nature. So I'll name a few. So one is a Nifty 50 equal weight index fund. I'll go a little more into the numbers of this so that also we'll get to understand what is the reason behind that. Then you have a Nifty mid cap 150 momentum 50 index fund. So what it does is it takes the universe of the mid cap 150 stocks and picks up the momentum 50 companies that you can possibly invest into. The Nifty 500 value 50 index fund. So this is for a conservative investor that I was referring to, that they want to invest into the market, but want something which is fairly valued. So they look at the valuation basis, and the stock selection of the 50 companies will be based on the valuation matrix. Then you have a Nifty small cap 250 momentum quality index fund, so which has 100. I'll repeat it because I see the expression.
It's a mouthful, yeah.
The expression
Nifty 100?
No, Nifty small cap 250.
Small cap 250.
Momentum.
Within that momentum.
Quality. 100 index fund.
100 index
So what
fund.
it does is, in the universe of 250 small cap companies, it'll pick 100 companies filtered on the matrix of momentum and quality.
Got it.
So in my view, if you're a small cap investor, you don't really want all the 250 companies in your portfolio. Why are you investing in small cap? One, because there is momentum in those companies. Secondly, you want to ensure that you're buying into quality companies. You just want to pick everything that is in that space. So this smart beta fund helps you do that. So it is a Nifty small cap 250, momentum quality 100.
Wow, that's an interesting one. So now the rationale is clear that I think investors can go back, do their own homework, and see if these filters work for you, and then choose the products which could be appropriate. We have a question coming in, and let's take that as we start wrapping up. This is a question coming in from Sam. He's writing it on Instagram, and he's saying that are passive funds more cost effective, and if they are, then will this impact the CAGR return on the investment over a long period of time? So are they basically more efficient and better to be in? I think we've come back to the starting point, Pradeep, on this. So summarize for us the thoughts, because cost is a very important parameter, especially for someone who's, not looking to trade in and out. You're looking to ride that fund for the next 5-6 years.
Right.
So then what are the things to consider?
See, cost is a consideration for sure. When we talk about cost, active versus passive, typically there is a 100 basis point, about 1 percentage point cost difference between these two funds. Now, the viewer has asked the right question. This 1 percentage point looks very small, but if you accumulate it over a period of time, it tantamounts to a lot of money. I'll give you a data point. We did an interesting exercise recently. From 1981, Sensex, since the time it came into being, 1981 onwards till today, if somebody had invested 100 rupees in Sensex in 81, and then the value of that today, it compounded by something like 15.2% CAGR. And in terms of multiples, it is like 456 times, which means 100 rupee put in 1981 is worth 45,600 rupees as we stand today. Now, we did another analysis. What if one fund had delivered 2% alpha over and above Sensex return? Instead of 15.2, it becomes 17.2. This number of 456 becomes 1,000 times. 100 rupees, instead of becoming 45,000 rupees, becomes 100,000 rupees, 1 lakh rupees. That's the sort of difference a 2% can make over 25, 30 years. Now, obviously, I'm subtly pitching for active management here, but the same thing in inverse can also work in terms of cost. When you accumulate costs over a long period of time, they also kind of add up to a lot. And that's why the attractiveness of passives come into picture whenever there is no alpha to be found.
Okay, so go for passive if there's not enough alpha, if the fund is not beating the benchmark or its peer set substantially. I guess that's a important takeaway. All right, gentlemen, thank you so much for joining in. That was a very, very helpful conversation. Lots of food for thought. And I think investors can go back, do their homework, and then decide what is the right blend of both active and passive strategies in our portfolio. That's a wrap on this week's edition of Let's Talk Money. Keep sending us your feedback, your comments and queries. We'll see you again on the show next week.
Let's Talk Money